afternoon, everyone, and welcome to Stock Market Today. Ali Corman, Justin Nielsen here with a breakdown of the action in today's session. And it was a pretty wild day on Wall Street, Justin. And could this be the start of the comeback that we've been looking for?
It could be, but not necessarily. A lot of times you will have in a market downturn, you will have these days, these rallies that look very powerful, but one day does not a rally make. This is what we call a rally attempt. But we'll get into that a little bit more. We're going to cover some stocks, news on Kohls with an unsolicited offer on that. CF holding up really well, and then big turnaround in energy. So we'll take a look at Devon Energy.
Yeah, it really was. We'll check in on all that. Justin's like, hold up, market. You have a
Right,
lot
exactly.
to prove yourself first. You have a lot to prove yourself first before I'm going to be interested. And let's explain why. So let's take a look at the NASDAQ composite here, which finished the day up about 0.6%. The Dow and the S&P 500 up 0.3% apiece. The Russell 2000 up over 2% for the day. And I mean, a big comeback, Justin, when you consider the intraday losses that we face in this year is still a slightly delayed chart. We did finish in the green for the four major indexes.
Yeah.
So a potential reversing of the tide, but we can't get too excited yet.
Yes, and the reason is because if you look historically at some of the the biggest reversals or even the biggest days, sometimes you see these very powerful days. There have been days where the Nasdaq was up 14% or more. We've got plenty of days that were up 10% or more, and you would think, oh man, you can't miss those days because if you do, then your portfolio is just never going to be able to catch up. But they're usually surrounded by the worst days, and so one day does not a rally make. And just so you know, the top 15 days percentage gain wise, they're like in 87, 2001, 2002, 2008, and 2020, our most recent addition to that top 15 list. So really amid like these crashes and these really horrible times, that's when you get the biggest days. Now, this was a great reversal. I love looking at reversals. They are, often a very powerful sign. But look, we've got some headwinds that we're looking at. We've got a whole issue with Russia and Ukraine. We've got the Fed meeting coming up on Wednesday. We don't know what's going to happen there in terms of no one's expecting a rate hike, but I think the language could really put investors on edge. We've got earnings coming up. There's a lot that could shake this rally very, very easily. But when it comes down to it, look, the NASDAQ was down almost 5% today when it was at its lows. The red was everywhere. And, Scott St. Clair on IBD Live today was talking about how when there's blood in the streets, that's where you don't want to be short. That's where, you're usually going to be expecting a bounce. And David Ryan, at the end of our show, I read a text from him. He was talking about one thing that was a little different about today was as opposed to last week, we saw a lot of days where you were starting off strong and just couldn't keep it, So he was saying, as early as 7 a.m. Pacific time, hey, if this one starts off weak and is able to close strong, that might be an interesting turning of the tide.
Yeah. And only time will tell, especially the next couple of days for sure, if that tide will continue to turn positive. So we don't need to go all in today. We can wait for the market to prove itself to us, and there will be plenty of chances to get in if this thing can gain steam.
And I'll say, look, there's no day that is going to convince me to go all in because I don't care how strong it is. It's just one of those things where if you've been doing this long enough, you know that a lot of times the incremental moves are going to be what helps you the most. It's most of us aren't plungers. We don't plunge in, plunge out. It's more, okay, look, I've been in cash, so I can watch from the sidelines and watch the destruction and not get bothered by it. But then when I start seeing reversals and I start seeing some stocks that are holding up, that's going to get my attention. And I'm going to note it at first, maybe take some probe buys, but there's no reason to get in heavy right here. One thing I will say, for as much as the NASDAQ, we were talking last week about some of the levels, and there was that 14,200 level that we kind of saw holding up. And that was right around the October low. We plunged through that last week. That's going to be one of the things I'd like to see us get back to that level, because otherwise we could be looking as far down as the the March lows, at 12,400. But for the S&P 500, I'll say one of the things that's looking positive on the S&P 500 is, hey, can we hold above that October low? So we tested that October low right there at 42.78, plunged below it, but came right back. So that's something that's a great area to get support for the S&P 500. But again, this is just day one. Let's not get too excited yet.
Yeah, that's exactly right. And the S&P close to its 200-day line. So we'll keep an eye on that as well. Just breezing through some of the other major indexes, a big upside reversal also for the Dow today, undercutting its November low, but popping back above it. Small caps with a big percentage gain today, but a lot of ground to make up here. Up over 2% today. And now let's take a look at some ETFs, Justin, to check in on how growth stocks fared today. So it looks like the FFTY, after a brutal beating for the last couple of months here, trying to find a bottom with an upside reversal of about 0.7% today.
Yeah. And I mean, this just goes to show you that growth has been very out of favor. We keep on saying that, I mean, in a lot of ways, there's been really a bear market in a lot of stocks since February. And so this downtrend has been pretty persistent, but certainly since November 22nd, that peak, a lot of destruction has happened since there. This hasn't been a great start to the year. I would say, the IBD breakout stock index, that did hold up a little bit better because it started getting filled with some REITs and some things like that were still in those breakout areas. That one's holding up a little bit better, and you can see that kind of got support right there at its September and October lows. And there certainly was a lot of destruction. I mean, there was not a single sector spider ETF that was up today at one point. They were all down, and the ones that were leading were your XLP, the staples. It was the utilities. It was the most defensive things you could think of. But that certainly went topsy-turvy by the end of the day. Energy went from worst to almost first. I think XLY beat it at the end there. And so did XLC, it looks like. But it really had a big turnaround. A lot of the stocks and sectors that were the worst hit were the ones that were coming back at the end. But here again, you have to be careful. A lot of these sectors are filled with stocks that just don't have great looking charts.
Yeah, that's exactly right. And we'll get to energy in just here a little bit with a look at Devon. But let's talk about retail, because we have Kohls making headlines today and finishing pretty strong. It looks like up about 36%, trying to get to its highest levels in quite a while, Justin. The retail area, broadly speaking, performed pretty well, surprisingly, in 2021, and other names in the group moving up in sympathy today with Kohls on an unsolicited offer. So this is a big gap up in the stock. So it looks pretty impressive at first glance, but what should we be thinking about when we see something like this in the current environment?
It's hard to ignore a 36% move in a single day. And again, it wasn't like, Kohl's was just alone. I mean, Macy's was up, Dillard's was up, Urban Outfitters. It was bringing a lot of other retail names. And certainly I would have not been the one to say, oh yeah, in COVID times, let's bet on retail, some of these old department stores. But I mean, they were working, as you mentioned, for quite a while in an amazing way. But so what do you do with an unsolicited offer here? You've got this big news item. Some people are saying, well, yeah, gosh, I want to be a part of this, because there could be maybe some more bids, but it could also just fall through. So I think that there's a lot of risk to go into a stock that's up 36% and is, there's a lot that can go wrong here. So I'd rather just stick with the things that had set up before. I mean, this was trading below its 200-day moving average line and its 50-day moving average line, the 40-week and the 10-week, if you're looking at the weekly chart. So look, this is one day, sure, and there's some news that, at best, let's say the bid is accepted, well, then it's going to go flat pretty much from here. So you're not going to get that much of a gain, but if the deal falls through, you could be looking at some serious losses. So you have to be careful with these merger and acquisitions.
Yeah, don't try to chase the shiny objects during a correction. Yeah. All right. Well, let's also take a look at CF Industries, one that we've really been pointing out as a stock that's been showing exceptional relative strength in the last couple of weeks as it works on this ascending base. It's in the chemicals agriculture group, which is a strong 10 out of the 197 groups that we track, and a potential early entry today following up on a nice reversal we saw on Friday for the stock.
Yeah, one of the things that I thought was impressive about CF was that even when the market was down at its worst, this was still up. This was bucking the trend. And that's something about ascending bases that is worth noting. A lot of times, your ascending bases are going to happen during market weakness. And what sets them apart are these are the stocks that they're pulling back, but each each low is a little bit higher than the last low, and it's resisting that weakness in the market. And so you see here, CF has generally been getting support right around its 50-day moving average line when you had all the indexes plunging below their 50-day, their, even 200-day line. So the fact that it's showing all of that strength, and look at, we're still 8.6% off the high here, but the relative strength line already in new highs. So this is just very typical of an ascending base look, where it's bucking the trend, it's showing strength. Now, generally, when we're going to be investing in ascending bases, we want that power to be there. We want the market to be behind us, but it's certainly worth looking at this one. I would take a look maybe at Redmond Industries back in 1967. If you have How to Make Money in Stocks, it's going to be in that book, that orange book that Bill wrote, the 4th edition, in the top 100 charts in the first chapter. That was kind of one of the first ascending bases that he identified. And so that could be one that you use as a model. And it had an ascending base right after its cup with handle.
Perfect. Thank you, Justin. Yeah, a lot to like about CF right now for the watch list. And energy, pretty stunning comeback today as well. So DVN here, a big upside reversal, up about 4.9% in some heavy volume. So looking pretty good. Support and a reversal right where you'd want to see it.
Yeah, and certainly when we've been talking about the sector fund, the XLE, I mean, that's certainly dominated by ExxonMobil and Chevron. But you had a lot of these the U.S. explorers and producers, that's been one of the groups, one of the industry groups that has been one of the top for a while. And if you just looked at the groups that have done the best so far this year, I mean, I know we're still in the first month and we're not even done with that, but really it's filled with oil and gas. I mean, that's just where it's at. And then you got some gains in, 15, 14 and so on. A lot of 10% plus gains already for the year in this, in a lot of these industry groups. So here again, what is going on? This pulled back to the 50-day line, got support. We've got the relative strength line right there at new highs when the price is not yet at new highs. And this is, again, one of the groups that's been already proving itself. It's been doing very well. So this wasn't really coming out of a base. This was really coming out of a bounce off the last time it kind of got below the 50-day moving average line and then came back. So it just kind of tested that 50-day line again. And, this is still an area that is well worth watching because there's certainly at the start of this year a lot of strength to be had there. And it's been a lot of these stocks have been trying to resist the downtrend. And those are the ones that should be top on your radar.
Yes. So it's not doom and gloom everywhere you look.
Right, exactly.
So that might be tempting for investors to want to try to sneak in there, get in right at the bottom, put some money to work. But what do you say to them, Justin?
Well, look, there's a lot of broken stocks out there, and there's tons of people that are like, oh, I can get this on the cheap. Here's Peloton that was trading at, such a high price, and I can get it at on sale. But it's not about getting the lowest price. So many people say this. Mark Minervini says it. David Ryan says it. It's not about getting the lowest price. It's about getting the best price when the odds are in your favor. And we want to be looking at the stocks that showed strength because those are the ones that tend to show even more strength when the market turns. So that's where I'm focusing, and that's where I'm building my watch list.
And if you do want to dabble, whether it is, in a reversal in Devon or, playing with a market ETF, make sure you keep an eye on that exposure and you have a line where you're getting out because we don't know. We could be in for a bumpy ride from here.
Yeah, risk management is always key. If you don't have risk management rules, you're gambling. So it's just you have to have those losses. keep them small. You have to have your lines in the sand, and don't get to a point where you freeze, where you're like, oh, it didn't go the way I thought it was. Well,
Now
I'll
I'm a
give it a little
long-term
bit more room.
investor.
Yeah, now I'm a long-term investor. Yeah, when it starts kind of going through your areas, don't wait and say, oh, well, maybe it just needs a little bit more time. A little bit more time could just mean more losses. So always be aware that there's that downside. These stop loss policies, they're your insurance policy. Sometimes you're going to lose on them, but when you have those catastrophic losses, it's going to save you a great deal.
It sure is. And we talk about portfolio management strategies and the psychology of investing, in addition to our buy and sell rules and our take on market conditions every morning on IBD Live. So we hope everyone joins us tomorrow morning. We're going to have David Ryan join us back on the show. He was a portfolio manager under IBD founder Bill O'Neill for many years, ran a hedge fund and a mutual fund as well. So many years of investing experience under his belt, and we're so lucky to have him every Tuesday on IB Live. So we hope you join us.
And I can't wait to get his take.
Yeah, we're excited. We're excited to hear what he has to say. Maybe we'll pull up some intraday charts, and he'll show us some of the levels that he's watching. All right, tune in investors.com/IBD Live tomorrow morning. We'll see you there, and we'll see you right back here after the close.